Welcome back after that break. As we transition to our next discussion, we delve into the world of factor investing, an approach that has gained significant traction in the investment landscape. Factor models built on quantitative strategies aim to systematically identify return generating attributes in stocks. But the critical question remains, are these models the holy grail of alpha generation, or are they merely a passing trend? While some believe that factor based investing is the future of active portfolio management, others argue that markets evolve and factors that work today may not necessarily perform tomorrow. So, this session will explore the efficacy, longevity, and adaptability of factor models in delivering sustainable alpha. Now, let's welcome our eminent speakers, each of whom brings a unique approach and a wealth of experience. We have with us Mr. Anirudh Garg, partner and fund manager at INVasset LLP. Mr. Garg is at the forefront of financial innovation and quantitative investing with a strong academic background, holding a Bachelor of Business Studies from Shahid Sukhdev College and a Master's in Investment Management from the ICMA Center. Mr. Anirudh has developed and refined algorithmic strategies that drive his investment philosophy. His pioneering work on INVasset Aid, an algorithm rigorously tested since 1987, led to the establishment of INVasset in 2020. And today he manages rupees 400 crore in proprietary funds and rupees 400 crore in client assets, demonstrating his expertise in systematic investing as well as alpha generation. We have with us Ms. Sonam Srivastava, founder and fund manager at Right Research. She comes armed with over 9 years of professional experience in systematic portfolio management and quantitative trading. She has previously worked with HSBC, Edelweiss, and QPlum, where she built and managed large-scale trading algorithms and factor-based portfolios. Ms. Sonam is a globally recognized researcher in machine learning applications in finance and holds a master's in financial engineering from World Quant University. An IIT Kanpur graduate, she has successfully built a business out of her passion for quant finance, leveraging data-driven investment strategies. We have with us Mr. Rishabh Nahar, partner and fund manager at Code Invest. And he is an accomplished quant fund manager with over 8 years of experience in the equity markets. Since 2016, Mr. Rishabh has been managing funds with a research-driven, data-centric approach, working alongside a team of quant professionals. Mr. Rishabh also manages capital for prominent family offices in Mumbai, consistently delivering optimized investment performance through innovative quantitative strategies. And this very, very eminent panel is going to be moderated by Mr. Siddharth Bora, Head Quant Investment Strategies and Fund Manager at PL Asset Management, holding multiple credentials, CA, CFA, and CMT Level 2. He spearheaded PL's entry into quantitative investing with Aqua, India's first adaptive multi-factor equity PMS, which delivered 75% plus returns in its debut year. Under his leadership, PL's PMS AUM crossed rupees 500 crores, blending data-driven insights with traditional investment wisdom. And Mr. Siddharth was recognized by Asia One as a top young leader in 2022. He continues to redefine quant investing in India. What a pleasure to have you, Mr. Bora. It is now over to you to moderate this session.
Thank you so much, Aishwarya, and a very warm welcome to all the fellow panelists. Hi, Anirudh. Hi, Sonam, and hi, Rishabh. Looking forward to an insightful conversation and a good understanding of all the things you guys are doing, how we're navigating these markets. In the last 2 years, we've seen so much change, right? We've seen a bull market in first half of 24 and the last 12 months of 23 as well. We've seen a bear market in the last couple of 2-3 months. We've seen a sideways and a consolidating market. So I think the last 2 years has shown all the different colors and sides of the market. So let's just start with quick reflection of what you guys made of these markets, of your strategies. What are the big wins, the big mistakes, the big learnings, the big improvements that you guys made in the last, over the last 2 years? Let's just reflect on that to start with. Anirudh, how about starting with you?
Yeah. So the last bull run that started in June 2022 has been pretty much okay. I would not say okay. It's been very good. I think our CAGR is somewhere around 37, 38%. The market, I think, has done I think 19% if I'm talking since inception. So I always want to be in that 1.5 to 2x of what the market is doing zone, and I'm happy with it. So in terms of return, satisfied. The bull run was, I think, dominated by capital expenditure this time because the other shoots were not that much present, and we capitalized on it. The mistakes, yes, we made a mistake that we did not, we over concentrated our bets somewhere, which to a level that I would not have liked. But the good thing was that this bull market correction that came, I think we are one of the only PMSs in India who are holding 100% cash in it. So it didn't affect us much. So we compensated for that, what we did there. So these are the paths, but I believe the good thing is you have to stick to your strategy. Sometimes what happens as quant managers, since you have the power, you sometimes are not able to, your greed and fear, your sentiments also come in. And sometimes you have to take a lot of care, a lot of care to not let them dominate the strategy. This is a learning that has been for me for the past 3 years, that never ever let your sentiments take over the strategy. And I have a very, very strong belief that all fund managers who are outperforming the benchmark over a 3 to 4 year period are, their strategies are nice. And you just have to stick to your strategies. I think in stock market, as Morgan also said, everybody is right. So you just have to stick to your strategy, and that's it. You just keep on refining it. As Aishwarya started, she said that factor model is just a passing trend, or will these factors exist in the future as well? I'm 100% sure they will not. Yeah. So, but ultimately, that is what we are here for. We have to, with our experience, with our learnings, with our mistakes, with our wins, we have to refine them from time to time. We have to learn from each other. And that is what I think the last couple of years has been: a lot of learning, a lot of joys, a lot of pains. But that is what will refine our factors and our strategies from time to time. That is the strategy that I've followed for the last 16 years. I'll just continue to learn from every bull run, every bull market correction or bear run.
So very well put, Anirudh. I think the two big points that I got from what you just said, one was when markets get tough or things are not working out, don't let your emotions override the model and stick to the model, stick to your strategy. Don't let your personal biases come in. And the second thing is what you said, very controversial statement, by the way, whether these factors will not be relevant whatsoever. We'll take that up in another segment of the discussion. If these factors are not working, what are the factors that will work? Or does a factor investing approach not work at all? We'll take that up as we go along. Sonam, let's hear from you also about the last 2 years. You're on mute, Sonam.
Yes, hi. Yeah, I was just saying that the last 2 years obviously have been quite exceptional, right? We've all been greedy during the bull markets, and what I think we've done well is sort of being able to pivot the sectors and industries. Our factors, we sort of look at a whole breadth of factors. So I think we've been adaptive quite well. But yeah, I think the current scenario is what came as a blind spot, I would say. If you look at the last few years, there's been a bias that everybody wants small caps, mid caps, micro caps, the broader you can go. So that is something that we did, Siddharth, that we expanded our universe as much as we can. We want to go to as many stocks that we can. And it worked for us. I think our sector selection and factor selection was right. But, when the trade war started, that came with a surprise that, suddenly small and mid caps are seeing a meltdown. And for me, I actually, before I started Right Research, I saw a huge amount of pain in the last trade war, right? In 2018, 2019, I saw a couple of companies I was working at shut down, and it was a whole thing. And the reason for me starting Right Research was actually that we should have a strategy that can adapt to any market. I think factor investing does that, and I think that's what we have to do right now. But I think we have learned a lot. We've added more factors. gone deep into economic data, gone deep into different sort of data sets. I think there's a lot of exciting opportunities there across the board. And I think this new time in the market will be a good challenge to solve, right?
I think, what I'm taking away from what you said is that factors will stay relevant, but which factors are relevant at what period of time will keep changing. And it's up to us to, make models adaptive enough to change to these factors as market conditions
Yeah,
keep.
definitely. And like Anirudh said, right, that sometimes bias can build in. So for us, somewhere around the line, a bias was built in into our models that, we want to expand our universe as much as we can. And we have to keep on learning from it, how to, sort of do this better.
Rishabh, let's hear it from you.
Hi, Siddharth.
Hi.
So, I think the last 2 years been great, right? 23, 24 has been pretty much a bull market. And I think that, most of the learning has come in the last 45 days. So during bull market, it's pretty much like, you don't need to learn much. You, the last 6 months, in fact, from like, April, May, you buy a stock, it's up. There isn't much, to be done, and everyone's been outperforming the market. But the last 45 days is probably a reality check for a lot of investors, especially on the small and mid cap side. And, like Sonam said back in 2018, right? Like, if you run a back test up until 2018, like 2014 to 17, the kind of, the returns that you were seeing, right? And most like a lot of quant funds started shop in 2018 and 18 to 20 and was like pretty much a lot of pain. And I think the last 45 days has given, the small and mid cap space a little bit of that people now start believing, okay, there is something like drawdown and there's something like risk management and, those kind of things have to come in play. And, so fund managers like us, that's where, I think that's where we need to come in and not only completely rely on the back test, but take a data set driven call that, if you look at small mid cap valuations, right? It's yet above it's 30% above like the 20-year average or 10-year average. So it's, like Anirudh is sitting on, pretty much a large amount of cash. So that's a call that he took. I don't know whether that was a quant call or a discretionary call or, it was a data driven call. But these kind of calls do help investors in times of drawdown. Also, a lot of new money, a lot of new money came in September, August. So the guys who invested September, August, fully invested in, small mid cap have seen a lot of pain. See, guys who entered in 2022, they've already made money. You're seeing drawdowns from, peaks or from profits and other thing. But new investors, starting out. So to manage that pain is wherein, where fund managers like us have to come in and make sure that new investors don't see that pain, because for a lot of these guys, it's a first time bear market, right? A lot of quant funds, it's a first time bear market. So, maybe asset allocation comes into play out there. So I think, it's going to be like fairly good to see how this next 2, 3 months plays out and how managers manage AUM now. Yeah.
So I think the one thing that changed in India over the last 3 to 5 years was uh, basically investors' return expectations completely changed, because we saw a phase where 35% became a more normal return expectation, which was very unlike in the past. I think the long term, returns of this asset class is in the 12 to 18% sort of range. But clearly, the last 4 5 years have spoiled the expectation of people, and therefore changed the how the fund managers actually navigate and set the right bar for these investors. So I think this reality check was quite needed. Seeing the other side of equities is also important. And yeah, I hear what you said about the whole 2018-19 experience. So basically, even we've tested multiple different quant strategies, and almost none actually outperform in the 2018-19 cycle. I think that was a period where, factor strategies didn't really do so well. So I think historically also there are many years where active strategies have done well, some years where passive strategies have done well, and many more years where factor strategies or multi-factor approaches have done well. So I would just like to, understand each one of yours perspective on this, that based on all the research you guys have done, based on your live market experience, based on the back tests you guys have run, when have you seen the quant edge really play out in the market? And when have you seen it really fail in the market? Because I'm sure there are both phases to every strategy. Because if quant was the holy grail alone, like only one strategy performs every time, that would be an unrealistic expectation. So let's understand from you guys, when did you see the quant edge play out, and when did the quant edge sort of fail you as well? Again, Anirudh, let's start with you.
Okay, so mine has been very simple. For me, quant has never been, I don't know what quant investing actually is. Being a quant investor, I have no idea. But what I've done in my life is whatever I've learned through my experiences, that I have coded into quant.
Right.
Suppose whenever we are buying value, I buy value and only when there is overall value in the market. Otherwise, I feel that I'll be stuck in something like a value trap.
Hmm.
Okay. Then in the bull markets, we are all, I don't know if people acknowledge it or not. Everybody is some type of a growth investor. Somebody's doing momentum, somebody's doing momentum in balance sheet, somebody doing momentum in prices. Yeah. So everybody wants growth, relative change. We spot relative change. We like companies which, you know, have an advantage today that they did not have yesterday. Finally, in expensive markets, you know, to answer a question exactly, this third stage answers it. When the markets get expensive, you need to lower your beta a bit.
Mhm.
You need to tone down your expectations a bit. The problem with us in stock market is that nobody will come to us in a bear market to invest.
Hmm.
All the investing AUM and the investors that you get
Comes
on the
at
top of the
peaks.
market comes at the peak. Now, what do you do about it? So my belief is that markets can stay expensive for a very long period of time. Just turn to those Warren Buffett type companies and stay invested there. And finally, there comes a time when when your models are screaming that, okay, guys, this is highly exuberant. Okay. Just a very simple, all fund managers will agree. Just look at your AUMs growing and the rate of growth of that AUM in the last few months of a bull market. Yeah. So that gives you an indication. So somewhere behaviors, Siddharth, to answer your question, has a lot when it comes to how quant strategies, I believe, should be designed when it comes to navigating through bull market and through bear market phases. You will come to know that, okay, at the end of a bull market, you're getting a lot of AUMs and the stock prices are, going off the roof. As Rishabh rightly said, that the returns expectations of the people change. And, people, uh, for me, a big reality check comes from my investors only. There was this one wonderful investor who invested 50 lakh rupees with me in 2022. At the end, uh, I was talking to her in 2024, around September, and she was very new to the market. And I was like, "How much have you invested in the market now?" She's like, 8 crore rupees. I'm like, "Wow, you've given us just 50 lakhs." And she was like, "No, I've invested on my own." So all these things needed to be, I think they need to be a part of your, algorithm. If you can make data like that, which is quantitative, qualitative, once you start exploring it, you get, initially we were like, how do we do it? It's very difficult to do behavior checks. But ultimately, when you think about it, somewhere you get these data because it is very essential to protect money as well. See, the 2008 financial crisis, the COVID crisis, if we are not able to save money from in these crises, the whatever we have done in the last 3 years is gone. Right now, personally, that's my belief. I believe it's a bull market correction only, and there's not a lot to worry. But I may be wrong. But when a bear market comes, when there are signals for a bear market, then 2008, I remember the best of the portfolios, the ones which are said, and I won't take names, but the ones which are said to be the most safe ones, the older ones, the bigger ones, the portfolios. If you look at the NAVs, the portfolios were down 80%. The stock market came down from 6,500 level to 2,250 levels. And then we saw the crash during COVID. We had all seen portfolios coming down. You must have tested strategies. A lot of strategies that we used to test came down 40%, from 2018 to 2020. So that kind of money cannot be lost for investors.
Right.
So somewhere, I think as fund managers, we need to tell them, okay, you give us money at the top, but have a 3 year vision, and maybe in the last we are not participating for you. You need to take a breather. It's You have come at the very end. You have to, one of my investors I take a lot of learnings from my investors. One of my investors told me that when I did not invest for him, he said that it's okay. It's our journey as investors as well to learn from the fund managers. So we trust your call in that way. Yeah, so investors also have to learn. We also have to learn that when the AUM is coming, we need to have some kind of different portfolios, maybe hedge their portfolios. We need to protect them a bit when they're coming at the top, because we know they do not know. They're just carried by FOMO, or when money is made and the confidence is built over the last couple of years. We as fund managers, I think it's our prime responsibility to tell them that, okay, it's time to take a breather. Stock markets, the valuations go, again, there'll be a cycle. Again, you'll get better opportunities, and again, you'll invest.
I think what you said is basically the genesis of why momentum even works. These behavioral patterns actually create what we call the momentum factor. It's the FOMO that people want to keep chasing returns and everybody feels left out. So they come in at higher levels. That's how momentum is built in markets. And I think right now what we're seeing is the unwinding of that momentum. We're literally
Absolutely.
seeing the exact reverse going on, and people are selling in fear. I'm tracking all results across most sectors. I'm tracking management commentary. I'm tracking a lot of news flow as well, actively. But right now, we are seeing a market where maybe the commentary is good, the results are good, but the stock is beaten down. The news flow is positive, the markets are getting beaten down. Inflation numbers are lower, markets are taking a beating. RBI is cutting rates, infusing liquidity, still no effect. So I think
So,
the big
Siddharth,
change
I would
I'm
like to
seeing,
add to it something that has helped me a lot, and I
yeah,
think will help our investors and all. That, bull market for me, I think it feeds on bad news.
yeah,
Whatever bad news comes in the bull market is not concerned. Okay, the bull feeds on bad news, but when the bear come, it feeds on good news.
yeah.
How many good news love, and then the markets, the ultimate aim of the market is, okay, to correct the valuations, to get the imbalance in the market in check. So just to add to what you were saying.
Yeah, so I mean that's what I was saying. The big change in the market over the last 5 years has been that before the last 6-8 months, every bad news was being discounted and markets kept moving higher. Nobody cared. And now every good news is being ignored and markets keep going lower. Nobody cares. So I think two sides of the market we're seeing in the last sort of 2-3 years. Uh, you know, I think Sonam, let's hear your perspectives as well. When did you see the quant models really help you do things differently? And when did you see that quant models could have done better or, didn't do as you would have liked them to do?
Right. So that one thing I would add, my opinion is that I think quant models can work in every market, right? That's what I believe. And see, I don't know how to do anything apart from quant. And as an investor, I sort of try to build in models that can adapt and work in every scenario. But yeah, your philosophy can be wrong. So, so again, going back to 2018, I sort of used to work in a Europe focused strategy, right? And when the trade war hit, we saw, and we were very aggressive with momentum. We would just do momentum, how aggressively you can do, and that is all we cared during the bull market, right? And when the momentum sort of wind down, that is when the lesson was learned. And then, that's when I started working on other factors, right? When momentum stops, then what do you do? So therefore, while even as Trite Research, we do a lot of momentum, but our narrative is also always multi-factor, 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 because we know that when momentum stops, some other factor is going to play out, right? So even right now, if you look at 2018 and that volatile period, you would see quality as a factor or low volatility as a factor and some value even with quality. Those things would have worked very beautifully. They would have worked better than the market. So it's not like that quant doesn't work in any scenario. I think, what you need is more wisdom in how you sort of navigate between those factors. Therefore, we right now are obsessed with economic data, trying to simulate these scenarios and sort of include that into what we do. But yeah, I think quant has an answer for every market. And that's the lesson that I sort of have learned in my journey, right?
You can solve for the past, but the future remains uncertain.
No. See, you could have solved for this in scenario because you saw slowdown in
Yeah.
the economic growth, right? So
Whether it's
it's not
PMI
like
numbers, GDP numbers, all estimates, macro, there has been a slowdown.
there is
But I think the slowdown is usually a little more lagged on the macro front as compared to the markets. I think markets are reacting a little more faster than the macro data. That's just my broad.
See, I think it is because of the trade war and all the implication that is
Yeah.
happening, and
Yeah.
that can be painful for sure.
Yeah. Yeah. Rishabh, which camp do you belong to?
So, I think, so that the way we look at quant is like, I mean, we like to think in terms of first principles, right? I think quant is just a tool. So when we discuss internally, right? Ultimately, like if there's EPS growth and the business will do well, that's what you want to get to. You want to strip down to the basics. So we are not looking at quant as a black box or a tool that will throw out some magic formula, or it'll throw out a stock and that stock is going to outperform. I think so. The way we are looking at it is that can we work backwards? Like, what kind of businesses do you want to own? And, just like Anirudh mentioned earlier, right? Like what you've learned over the years, you want to implement that in the form of data. So, that's the idea with quant. So I don't think so, like, whether you want to term it quant, whether you want to term it data driven, I don't think that is as significant as if you want to strip it down to the basics, right? What kind of business do you want to own? Where are the markets placed today? What kind of position size you want to buy? So, that's the camp that I belong to. So I think so, like, the different quant. So the earlier back in the day, like 2016, I would run back tests and, leave my brains on the side thinking that, okay, this back test has done well, so this will continue to do well, right? But, it wasn't like I wasn't thinking ahead of that. But over the years, what we've realized is that, can we strip down to the basics? Why did the back test do well? What kind of businesses do you own? What kind of cycles do you go through? What businesses do well? Like, growth has done phenomenally 2022 to 24. 2018 to 20, like, everyone's back tested hasn't done as well. But ultimately, you want to see that, like, we are in this for 5, 10 years. The moment, your time horizon extends, it becomes a lot easier. If you're looking at 1 month, 2 month, 1 year, it's anybody's guess, right? We don't know if yesterday was the bottom or yesterday was just the start of a bear market. So, I think quant, again, like we look at it just as a tool, and I don't think so. It is, like it's the answer to, yeah.
I think we've got I would say another 15, 20 minutes, and we have quite a few topics to, sort of touch upon. I'm going to, briefly talk about some of the critical questions which I think, all the viewers, participants, and investors might be interested in understanding. Since we are in the whole phase of, market correction, and it's all about, risk right now and volatility and drawdowns, let's take up a couple of risk-oriented questions before we move into the other aspects of each strategy. So I think, Anirudh, again, I'll start with you. What are you, doing in your strategy in terms of, managing risk, going to cash, hedging with options, buying gold, using stop losses, which are either sector specific or stock specific? Why don't you, take us through the insights on your model that you're following in terms of managing risk?
Okay. So for us, managing risk in each stage is different. When we see value, we have no definition of risk, because when there is value in the market, you have to be a little adventurous and go out there and buy. Because the only thing that people are looking and like right now, like अब सबको stop loss चाहिए, so this is not the right time. This is you're getting your things on discount, so go buy them. The main thing with risk is when what you can do right now is have a diversified approach. Do not be over concentrated in terms of market capitalization, like large, mid, small, or a particular sector. That is the best you can do. Buy those companies where you think growth will come. Everybody, knows the companies where growth will come for the next 2 years. You're just getting them on good discount. As the bull run continues, one basic line, since you said that, let's sum it up quickly. Reduce beta as the markets get expensive. So as you reduce beta, chances of participating in the next bear market or the bull market correction, they reduce. So you can reduce your beta. And as the markets become expensive, you just keep on reducing your beta. And finally, when you get them exuberant, so there is gold, there is cash. India is now wonderful market where options are not that expensive.
Right.
Yeah, options are not that expensive. Mutual funds can't do it, but we can. Yeah. So why not? You get options at very, very cheap prices. 3% for 6 months is not bad when you get those months where you're getting 10% in a month or 12% in a month at the end of a bull market. Those exuberances are being done, as you rightly said, Siddharth, when everybody joins in due to FOMO. You can do hedging as well. So you just have
permanently,
to.
you got to keep your portfolios hedged, or you got to time your hedges, just to follow on with that hedging point?
I think in expensive markets, in expensive markets, you need to take either of the steps.
Okay.
Yeah, because I believe return को मतलब हमें रिटर्न की एक्सपेक्टेशन वहां करनी चाहिए जहां पे वी शुड एटलीस्ट बी एबल टू मेक 50% कि हमें अपसाइड लगे व्हेन वी ऑल नो दैट देयर इज नॉट अ 50% अपसाइड फ्रॉम हियर सो दैट टाइम आवर रिटर्न एक्सपेक्टेशंस should tone down and we should look at diversifying hedging moving to large caps reducing beta gold cash कुछ भी करो मतलब जो भी ठीक लगता
Fair
है
enough. So you're saying use all these tactics like, beta reduction and diversification as opposed to using stop losses, because stop losses might
No,
not
stop
work.
loss is also okay. No, I'm not saying that. So that stop losses is also okay. I am not that big a fan of stop losses, but yes, market has taught me. As I said, we all learn from our experience. कि कुछ ना कुछ stop loss चाहिए in expensive markets because sometimes what happens is your portfolios get concentrated. So in that scenario, when overall market is not falling, but your portfolio goes down because it's a concentrated portfolio. Yeah. So try not to concentrate at the top, try not to fall into that extraordinary returns thing. When extraordinary returns are coming, I think one needs to be cautious that you know like returns make you divert from the reality. So somewhere when those things are there, you need to take care of risk, but not always. These I believe when the markets are falling, that time मतलब अब रिस्क की बात करके क्या फायदा जो बात थी वो तो ऊपर थी अब तो let's it's time to top up and
Yeah, fair enough.
make some money in the next 2 3 years.
Sonam, your quick insights on managing risk using stop losses, diversifying, position sizing.
No, definitely. I think, I mean, see, risk management can have various avatars in a sense. Uh, I think in this scenario, the wise call, let's say a month back would have been to pivot towards larger stock. That would be have been the best risk management. We have done, we've gone to cash. We have hedges deployed for more than a month, but the challenge in India is that you only get to hedge with the Nifty or the broad markets, which haven't corrected that much. So that doesn't help whatever is happening in the small and mid cap segment. I think in this scenario, cutting your losses and maybe starting that pivot towards quality makes a lot of sense.
Fair enough.
So I think that is something that we are also doing. And then see, I think we have a view of the regimes in the market. We saw our regime shift to a bearish zone, Siddharth, since I think August, September, right? And what our models did was they were in very, very safe sectors, and they were in defensive sectors, which were working extremely well till December, right? So we thought, they've got them right. But then we had small and mid cap as part of our portfolios, which saw a meltdown, and this new layer of adding quality to the allocation has come in, and so I think that's going to be critical. And yeah, it seems like that is what we sort of have to do. And I think maintaining cash levels and hedging, I think it will bring a lot of peace to investors. So I think we
Yeah.
should do that as well.
So I'll just give you an interesting data point. As you said that the headline indices are actually not showing the extent of the correction very clearly. So I think Nifty has corrected roughly 12% since its peak in September. BSE 500 has corrected roughly 14-15%. But 80% of the stocks have corrected more than 20% from its peak. So the
Right.
breadth of the market on the lower side has been really brutal. And I think 72% of stocks have corrected roughly 30% or more in the last 3 months. So I think the headline indices are not actually showing you the extent of how the markets have
Right.
shifted here. So I think if the breadth is so low and it's so sharp, any equity investor who's allocated to equity will sort of face some meltdown. So I think investors should not, worry too much and, pinpoint different fund managers. It's just the way the market is, and it's
Yeah.
a part of the cycle.
Right, and I would just like to add also here, Siddharth, that I said that, I've seen that market where I saw actual companies melt down in 2018, 19, right? And I think the critical part is that only if you stay in the market during this scenario,
Can you
you
recover?
make the most out of the next bull run. If you can do risk management, then that's perfect, right? But staying put is what is the crucial part.
Rishabh, any quick insights on risk?
Yeah, so I think Siddharth, like there are a couple of things in this. So from April, May, I mean, maybe June onwards, whatever new AUM that we received was pretty much divided. Almost 40-50% of that went into gold as a hedge. Now, like Sonam mentioned, right, there is, if you're running a mid and small cap portfolio, it's very hard to hedge yourself using options. So we actively do, hedge our portfolios all through November, December, Jan, Feb. So on the larger cap, on the large cap portfolios, you would not see any kind of drawdown. So staying invested would be very easy with a large cap portfolio and then hedging it using options. Your question earlier, Siddharth, to Anirudh, I think was, would you want to hold on to that hedge for the entire 6 months or a year? I think that would be really costly. If you would open a December hedge, could cost you like 5-6 kind of a
Yeah, so it
percent.
was
So
permanent hedge or time your hedge in
so
terms
you
of
have to time your hedge. Permanent hedge is just going to bleed because markets, I mean, over a 3-4 year period, markets are going to be positive, right? So permanent hedge is just going to be really costly. So you'll have to time your hedge, and for that, you'd have to have a model in place. So that's where quant would come into play. And the picture out there to subjectively time the market could be, again, really hard, anybody's guess. Now, the second thing is that I think so shifting sectors is really hard because when a bear market, like Anirudh mentioned, like 2008, right, there was no sector that was not down. So cash was your only call then, or another asset. If you want a straight line equity curve, then if you're trying to achieve like really crazy risk adjusted returns, then you would have to have an all weather portfolio, have multiple uncorrelated asset classes, which over a 5-10 year period would perform. But unfortunately, in India, we have very few asset classes that we could diversify within. So yeah.
I think diversification and hedging to a certain extent, switching factors or sectors to a certain extent, and finally everybody's agreeing that cash has been the king in extreme bear markets. So I think all of us need to work hard, except Anirudh, all of us need to work even harder on cash models.
Yeah, cash or gold, I mean,
I think
even
that
gold and
leads
other
me
yeah.
to my next very important question. And I think everybody needs to understand that in quant strategies, when we are managing money quantitatively, what is the level of active involvement? What are the decisions that are taken quantitatively? What are the decisions where the fund manager, you guys are using your own discretion? So what is active? What is quant? And what are those decisions? And Anirudh, again, let's start with you because you're sitting on a very brave and bold and successful cash call. So how did you get that? Was it your models or was it your understanding overall?
It was absolutely our models.
Okay.
See, at INVasset, one thing is very clear, that whatever decision that we take has to be finalized 2 years before. Okay. So a mode, like if a formula has to be developed, it will require 2 years before we can implement it. Yeah. So that क्या होता है ना market में, when you have your feelings attached, you are, we are not very different from retail when it comes when it comes to decisions. So if in market you take decisions spontaneously, something that you tested 3 months ago and then you implemented it. So that's what I'm talking about me. That that has always caused losses to me as a investor. So now I have made a choice that whatever I do, कम से कम 2 साल के लिए I'll sit on it and then this decision. So in a way that I finalize my decision making factors for the next bull run, a bull run before. And whatever learnings I'm having in this bull run, I'll implement them in the other bull run. Yeah. It's not that we are not working for the next 2 years. We are working, but we are just working and preparing for the next run. Ultimately, as quant managers, as any fund manager, actually, um, instant decisions will always, I believe, cause losses. Because somewhere your behavior, somewhere your psychology, somewhere your feelings of greed and fear, they do come in.
Because finally, I think whatever the model says, the final decision or execution has to be done by all of us only. So there will be a layer where, as humans, you might feel a little jittery. Fair enough.
Just like to add, it has to be a multi-factor model. As
Right.
many factors as you can, you should just put into it. Something that doesn't. I'll give you one small example of this. In 2008, I'll say this in Hindi. 2008 में क्या बोलते थे? This was like all over this market. 25 पे बेचो, like 25 की पी पे बेचो, 18 के नीचे खरीदो, 12 के नीचे घर बेच के भी खरीदो. So this was what happened in the Bombay Stock Exchange. ये बोलते. From 2008 to 2016, the Nifty never came below 18p. Yeah, so over there, not just get as many factors as possible so that you are able to navigate when the cycle or the way of thing or overall economy structure changes.
So I think instead of taking everyone's insights on this, I think we'll get our participants a little more insights. We have, I think, 2-3 minutes to wind up the session. So Sonam, I'm gonna take this one with you. When you look at portfolio construction and rebalancing, how do you go about it? Do you have any liquidity criteria, any market cap filters, any sector caps? Do you allocate equally across stocks, or do you have a dynamic weighting method? And how do you rebalance your portfolio? I think investors would love to understand, how you're going about actual portfolio construction and rebalance itself, so they understand quant from a cleaner perspective.
Right. So, see, we use models, portfolio construction models for this. What we would do is, your factors, they give you the ranks or the potential returns of different stocks based on the thesis. And then, we combine the risk and the correlation of the stocks along with this return projection. So essentially, whenever we rebalance, what we're trying to do is give you good factor exposure basis of the factor that you are looking at, plus reducing the risk. Another factor that we would look at, Siddharth, is reducing the turnover. We don't want to do a lot of turnover, so we put filters on that. We put filters on liquidity definitely for stocks because, as the AUM increases, that is extremely critical. We would also look at some, fundamental red flags, for example, any default probability. We have, acquired data for news flow. So we have any extreme news flow in terms of big events, if they might have come, we have that as a filter as well. And then, we take all decisions from the model. The model gives us allocation. It's not equal weight. It actually varies between stocks.
Dynamic model.
Yeah, but then we, even after that, Siddharth, on a daily basis, I spend most of my time just validating what the model is doing, right? We do not stay, sway from the model. It just comes out from the model, but then you're always validating that, is the factor selection correct? Is my interpretation of this factor correct? So that's what we keep on doing, that keep on checking and validating everything that is happening. And I think that is the most important part.
I mean, a lot of people, have this misconception that once the model is built, quant fund managers can, go to Hawaii and chill for the rest of their life. But that's not the case in real. So I think this was just to, good insight that you showed them. There's so much work while building the models and while actually even deploying these models. You can't just use it in a no-brainer way. Rishabh, for you, I think let's try to understand the whole session's about factors. So what is your whole perspective on factor investing? Do you use a single factor model, multi-factor model? Do you use multi-model strategies? How do you approach factor investing? Are you using traditional factors like quality, value, growth, momentum, volatility, or have you expanded your factor set beyond just the traditional factors which have literature proof? So let's just understand your perspective on factor investing.
Sure, Siddharth. So, just to break it down again in terms of first principles, right? Like, what do you want to buy, when do you want to buy it, and how much do you want to buy? So, what to buy is wherein like the multi-factor model comes into play, right? So, you could use, like we are using, say, ROC, ROEs, debt to equity, all sort of fundamental factors. Then, when do you want to buy? When valuation comes into picture. How much is, where that's the tricky part, right? So with quant, like I know I mentioned this earlier also on another discussion, it's hard to get to a 10, 12 stock portfolio using a quant model. If you're using a quant model, 30 stock, 35 stock kind of a portfolio, is pretty easy. But the moment, you're going to a 10, 15 stock, because the way we look at it is that quant works on the law of averages, right? And those averages, you could really outperform with a 10 stock portfolio, or you could. So if you want to move to a more concentrated portfolio, then probably some sort of fundamental analysis and, the quantum mental process will come into play. In terms of market timing, I think so macroeconomic factors is a key component out there, especially like, for example, like this September, we were pretty much on 50 to 55%, gold. So through this fall, that really, it just cushioned the entire portfolio as a whole, and the entire model shifted to a more low vol, large cap portfolio from a mid and small cap. So there, So I don't think it's just one factor, it has to be multiple factors because the market is a complicated place. And like you mentioned earlier, I don't think so, you can just leave the model. It's a constant learning process. So we like to stick like we love quant because it makes us disciplined. The entire approach makes us really, strict and disciplined, and following rules becomes a lot easier, at least for me, individually. So yeah, I mean, so it's pretty much it's a diverse thing. So I don't think so, it's a one factor back test and it ends out there.
Fair enough. Fair enough. So guys, just to, end on a high note, I think based on all the research I've done and all the things that my models are showing up, we are basically getting signals that markets are closer to, mid-cycle troughs. So here on, the recovery does look very sharp across some pockets of the market, where value has emerged, where extreme panic selling has happened, alpha compression has happened across multiple pockets of the market. So, the recovery can be equally good and sharp, and probably a great time for investors to top up in all quant funds using this correction to, average out their holdings and, ride the recovery rally with more AUM and more capital, and to get investors the confidence to, back quant strategies, support quant funds, and, really leverage the future of investing in their own portfolios as well. Why don't, we get a quick minute from each one of you of the improvements that you all have made, the, big changes that you all have made based on the recent learnings, so that the next phase in the market, whether it's a bull market, a sideways market, is much better for all our investors. Maybe a minute from, each one, starting Sonam, let's start with you so that all our investors are, back in a good mood, so to say.
No, definitely. See, I think, like you said, Siddharth, in the beginning, right? The companies that you are holding, they are getting exceptional upgrades and exceptional fundamentals, but there's a meltdown that has happened. And, you will see rebound, especially in companies that have a strong growth path ahead, the companies that are being upgraded because they have an excellent growth path ahead. So there will be a recovery on that. What we are spending a lot of time, Siddharth, right now is on the macroeconomic front, trying to understand how the regimes are shifting and how we can adapt. And I think that's going to be a focus area for us going forward. But yeah, I think it's going to be a journey, and I'm sure, I'm just waiting for the drawdown to recover. And I think I hope that comes soon.
So, Anirudh, any major improvements you've made in the last, 1 year, 6 months, basis your learning, so that the investors know that, okay, the next cycle is going to be better, is going to be different?
See, I think each cycle has its own characteristics. That is what is the beauty of the stock market than any other asset class. You can shift from being a shoemaker to an alcohol beverage maker. Yeah, that is the beauty that this asset class offers. And these cycles of bull market corrections, extreme bull markets, they are a regular part of the market. Markets reward you only for two things. Why does an equity investor make more money? Why does Nifty make more money than an FD? It's only because you're investing firstly in companies of extraordinary entrepreneurs who are doing something good, who are creating something for the world. And secondly, you are investing in times when there is extreme fear. So this is a time of extreme fear, and I think now generally what happens is people react when the fear comes. React करने का time पीछे था, अब वो निकल गया. Now is the time not to. The fear is played out. The movie is over. The horror movie is over. Now the good movie is starting. You know, and in the next couple of years, I believe for all the fund managers, not only INVasset, all of us, be it quant, be it not quant, from this level should be very, very good for the equity markets.
Very good input. Rishabh, any final remarks, from you of how investors should approach investing in these challenging markets, and what, feature upgrades you guys have taken to navigate any uncertainty based on your recent learnings?
Yeah, I think for that, I think there's no one size fits all in the market, and especially when if you're managing your own money, it's a different ball game altogether. When you're managing, money for an investor, it's very different, right? So understanding what your investor is like, I mean, momentum in 2024, maybe August was very different from momentum today, right? So when you're showing a momentum fund to an investor in August, he's pretty much like, yeah, I want to do this because this is 40% per annum. And, today he's not ready to see what the reality is. It's not that momentum hasn't seen this, right? I mean, it's pretty basic. You go through 20 years and you see that this happens very often. So, explaining to the investor and understanding yourself that you think that this investor is even ready for this, and that match, right? Making sure that matching his nature to what kind of strategy you're running is, I think, is a key component.
Fair enough. Fair enough. I think we've run out of time. Had at least 1 more hour of discussion left with all you guys, but I think we'll do it offline on another day. But thank you so much, guys, for all the valuable insights, live experiences, being so honest and transparent with everyone. And I hope all the participants have taken a lot of good inputs from all the discussion we've had. And I think the key thing to understand is that factor investing as an approach will continue to drive alpha. It's just that the factors will keep evolving. We cannot restrict ourselves to just 4, 5, or 6 factors, or just momentum as a critical factor, which a lot of people confuse quant investing with momentum investing. I think quant is much broader. Quant has the ability to become a value-oriented fund, a growth-oriented fund, a dividend-oriented fund, a vol-oriented fund, based on the market cycle it operates. And I think with more data sets becoming available to all fund managers and Indian capital market players, I think the sort of factors that we'll be able to create and manage will also sort of evolve, and it'll give a differentiated edge to a lot of investors. Finally, it's all about managing risk in a bad market, and there are 10 different ways of managing risk. And in the bull market, I think the narrative for everybody is same: chase returns, chase growth, chase momentum, and capture as much on the upside as you can. The first time investors are first seeing a crash of such a level in the last 3-4 years. So I think it is important to see this, to understand the asset class for what it actually is. It can't continuously give you 40, 50, 60% returns every year. That's not a realistic scenario whatsoever. So I think this correction gives you 2 things: one, a learning, and second, an opportunity to top up. So I think with that, let's sort of conclude this remark. Aishwarya.
Thank you very much to our moderator and our panelists for all of their insights and perspectives on how quant plays a role in investors' portfolio for alpha generation. Ladies and gentlemen, now we have to take a quick 2 to 3 minutes break and come back with our next session. And when we do, we will turn our focus to a critical question: how should investors navigate the market's next big shift? So stay right here, don't go away anywhere.